Okay, welcome everybody to CRI's GASB update. I'm excited for everybody to join us. I'm going to give just a couple more seconds to make sure everybody gets in. But we're really looking forward to learning a lot about what's going on with GASB and what we can expect in the future from GASB. And so we'll go ahead and get started. Go to the next slide, Yvonne. We have a little bit of housekeeping to go through. We are offering CPE for this class. You will get the certificates emailed to you. Some information from that will be coming in the chat in case you have any questions. You need to get your CPE, you must stay logged in with the link that was sent to you by email already and stay logged in for the entire webinar. You also have to answer at least 80% of the poll questions. We'll be going through some poll questions as we go along. There'll be multiple choice. The important thing to know, you don't have to get them right, but you do have to answer them. So make sure you're paying attention and answering at least 80% of those poll questions so we can get you your CPE credit. You'll get those certificates emailed to you from the email address shown on your screen. And if you have any questions about the actual CPE certification process, you don't get your certificate, anything like that, you can always contact marketing at cricpa.com and they'll help you through if, say, a week from now you haven't gotten your certificate. You will be able to get PDF handouts of the presentation slides through the chat box as well in just a little bit. All right, well, I'm excited to introduce our presenters. First, I'm going to let Yvonne Claiborne tell us a little bit about herself. She's a partner in our Melbourne office. And so, Yvonne, would you like to introduce yourself?
Sure. Thank you, April. I'm Yvonne Claiborne. I'm an audit and assurance partner with CRI in the Melbourne office. I've been doing this for over 20 years, and for the entirety of my career, I've worked with state and local governments, audits and assurance.
Great. We're also excited to have Dean Mead join us for the presentation. He's a partner in our government and public sector group, and he joins us actually from the GASB. So we have some very special insights from Dean that he's going to share. Dean, can you share a little bit about yourself for the group?
Sure. What I would add to that, I was at the GASB for 24 years and 2 days and loved every minute of it. And I've been at the firm now for a little over 2 months, and it has been exciting and challenging and interesting. And I'm very much looking forward to sharing our GASB update with you and to getting to know the people in the audience over time as a partner with CRI.
Great. We're really excited to have Dean with us because it's a lot of insight into some of the technical matters that the GASB has already given guidance on and that are coming up from the GASB. Your illustrious host, April Shuping, I am a partner in our Gainesville, Florida office. Have been working in local government, either within local governments themselves as in the finance office or as an auditor of local governments for well over 25 years. So I'm very excited to hear what Yvonne and Dean have to share with us today. All right, so moving on, here's today's agenda, what we're going to go through. We're going to talk about some recent statements that have come out that are kind of coming on board, things that we're going to need to know about soon, some statements that we are absolutely neck deep in or are about to happen, and then some other pronouncements, just some insight into some of the other pronouncements that have been issued and are upcoming as well. And with that, I am going to turn it over to Dean to, oh no, we have a poll question. All right, they caught me early. All right, so our poll question number 1. In just a second, you'll see a pop-up where you can answer it, but I'm going to read it to you first. What topic on today's agenda are you most interested in learning about? Accounting changes and error corrections, this would be like our old prior period adjustments. Compensated absences, which have been around forever, kind of seeing what's happening with that. Our leases, which are coming into play right now, P3s, and the ever exciting SBITAs, Section 457 plans and how accounting for those and disclosure may change, or anything else. So I'm going to go ahead and open that poll. In just a second, you should see a pop-up that lets you answer. A reminder, you have to answer at least 80% of the poll questions. This one, I'm not sure there is a right answer. So we're just curious as to taking the temperature of the group. What are you really interested in? I was lucky enough to hear about a lot about these at the National GFOA conference a few months ago, and it's actually the two that are coming out on top right now are the two that I think are really interesting, and you know, and I think they make a lot of sense. Whether or not they'll be easy to implement or not, I think it depends, and we'll learn more about that as we go through them. But all right, it looks like we've got just about everybody's answered. Wow, guys, I don't know that I've ever seen that. 100% answered. Great job. So we have got the split of our really deep interest from the group is pretty much equally split. Oh yeah, exactly equally split between accounting changes and error corrections, you know, things that prior period adjustment kind of things, and then that leases, P3s, and SBITAs. And some of you may not have even heard of SBITAs yet, so that'll be some really interesting stuff for you to start thinking about coming forward. All right, with that, we can move on, and I'm going to turn it over to Dean to get started.
Thank you, April. Hello, everybody. Good morning or afternoon, depending upon where you're calling in from. This past June, the GASB reached something of a milestone by approving statements 100 and 101. Now, it might sound alarming that the GASB has hit the triple digits, but I hope to allay that alarm with two things to keep in mind. First, no government has to apply 101 GASB statements. 22 of them have been fully superseded. 8 were basically procedural and added no requirements. Another 17 are narrowly scoped or address transactions that are not widespread and consequently apply to relatively few governments. I think the most obvious example of that may be Statement 58 on Chapter 9 bankruptcies, which I suspect and hope that very few listeners have ever had to apply. So that gets us down to 54 statements, which is still a lot to be familiar with, but they're not all monumental pronouncements, which brings me to my second point. Not all GASB statements are created equal. And Yvonne has already forwarded it to this slide that I think makes this point really well. It's based on a version of a slide that the GASB has been using, which I saw them use last month in a presentation. And it not only lays out the statements that are currently being implemented and that will be implemented over the next couple of years, but it makes a point that I often make in my own presentations, which is that seeing a bunch of statements with the same effective date shouldn't in itself be alarming. Some require very little effort or none at all because they are narrow and don't apply to all governments. So looking at fiscal years ending between June 30th and November 30th of 2022, there are 5 GASB statements that are effective. However, the only one that requires a major implementation effort is Statement 87 on leases, which I expect that many of you who are in government have been working on for quite some time now. Statement 89 on construction period interest should ease financial statement preparation effort. And Statement 98 requires nothing more than changing the title of a financial report. Like most omnibus statements, 92 primarily resolves issues in practice, which at a minimum shouldn't make more work for governments and possibly may reduce it. And then lastly, Statement 87 may add some work for governments who have Section 457 plans that meet the definition of a pension plan, but it simultaneously amends existing provisions to avoid requiring governments to report a large number of defined contribution plans, including those Section 457 plans in their fiduciary fund financial statements. And we're going to talk a little bit more about each one of those pronouncements, I think except for the Statement 92 omnibus during this webinar. Looking toward fiscal years ending between, no, send it back. I'll let you know, Yvonne. The perils of doing a presentation and not having personal control over the slides. Looking toward the fiscal years ending between June 30th and November 30th, 2023, the most significant efforts then will be for Statement 94 on public-private and public-public partnerships and availability payment arrangements, at least for governments that have those transactions, and many governments do not. And then Statement 96 on subscription-based information technology arrangements, or SBITAs, which may apply as broadly as the LISA standards. That statement includes all kinds of cloud-based subscription transactions that governments quite often have these days. The good news, though, is that both of those statements use the same basic approach as Statement 87 on leases, so you now have some experience based upon the work you've been doing to implement Statement 87. Statement 93 applies to a relatively small group of governments for which it provides really important exceptions that will make work easier for them rather than harder. And Statement 91 applies to relatively few governments and should not require a substantial amount of effort to implement. And then lastly, looking past fiscal year 2023 to the effort to implement Statements 99 and 100 should be relatively small. Though Statement 101 on compensated absences may require more work to prepare for. Luckily, the GASB's provided 3 years for you to get up to speed and get ready to apply it. Next slide, if you please. So for the December 31 fiscal year ends, and in most cases then for governments with fiscal year ends between January and May that would follow, the basic difference here is just a couple of statements that are effective in the prior year. Statement 89 is already effective for these governments. Statement 91 is effective for fiscal years ending December 2022 and then January through May of 2023. And Statement 101 on compensated absences would be about 27 to 32 months from now, rather than the 36 months or 3 years for the June 30th through November 30th fiscal year ends. Slide. So the first of the statements that we're going to talk about is a new statement. It was issued by the board in May of this year, Statement 99, Omnibus 2022. Next slide. So the GASB uses omnibus statements to address multiple practice issues that individually are not significant enough to merit a project to develop its own statement. So typically what happens is a need arises for relatively imminent guidance, and the GASB adds in the other issues that have been raised by stakeholders or that it's become aware of in practice since the last omnibus statement. Many of the issues that have come up during the implementation of the LISA standards have been addressed by the GASB through its implementation guides, which are Category B authoritative gap. However, the GASB determined that in order to address some of those implementation issues, it needed to amend Statement 87, which requires another statement to do. And since you're in the process of implementing 87 right now, and we'll be getting ready to implement 94 and 96 also, the GASB needed to make those changes promptly. And as you'll see in the next slide, at the same time, tackled several other issues as well. Yvonne, if you wouldn't mind, thank you. I will address all of these at least briefly. One thing I should note is that throughout this webinar, we'll probably keep referring to public-private and public-public partnerships as P3s, which is the way normal people refer to it in the real world. But I'd mentioned the Statement 94 refers to them as PPPs. Of course, the Paycheck Protection Program has since commandeered that acronym, and P3 is commonly used in practice, and it's easier to say than PPPs. Next slide. So I'm going to start with the two most significant sets of provisions in Statement 99, those related to financial guarantees and those related to derivative instruments. So with respect to exchange like financial guarantees, you know that Statement 70 addressed financial guarantees that governments extend, but only those in a non-exchange transaction. The guidance that was provided was different from what is required by Statement 62's contingency guidance for exchange and exchange-like transactions. So the GASB knew eventually it would need to return to consider whether to extend Statement 70's guidance to all financial guarantees, regardless of the type of transaction. And in a nutshell, after Statement 99, for all financial guarantees a government extends, it should recognize a liability and expense if the government determines it is more likely than not that it will have to make a payment on the obligation that it guaranteed. In other words, greater than 50% likelihood. Next slide. So Statement 53 on derivative instruments makes a blanket assertion that all derivatives that aren't hedges are investments. However, a derivative that started out as a hedge and then became ineffective doesn't meet the definition of an investment in Statement 72, which obviously came out later than Statement 53. And that definition is a security or other asset whose sole purpose is income or profit and whose present service capacity is based solely on its ability to generate cash or to be sold for cash. And that doesn't apply to those types of derivative instruments that were entered into as a hedge, not as an investment, and are no longer reported as hedging derivative instruments because they've become ineffective. So Statement 99 creates a third category, other derivative instruments, and requires that the changes in their fair value and the accumulated deferred changes in fair value while it was an effective hedge be reported separately from investment income in the statement of activities and the other resource flow statements. The GASB did consider a more specifically descriptive title for this category that would take almost half a minute to read. And I'm glad they didn't, because it just would have been a gigantic mouthful. And other, I think, is sufficient and provides a space for derivative instruments that might develop in the future that are neither hedges nor investments. Next slide. We got a poll question.
All right. So let's see. Move on to poll question 2. What topics are covered by Statement 99? And we have 4 choices. Pledges of future revenues, exchange and exchange-like financial guarantees, non-monetary contributions, non-monetary transactions, or all of the above. All right, we've launched the poll. Again, you don't have to get it right, you just have to answer. So if you're not sure, go ahead and pick your best guess. We have a partner in CRI who does give a little cheat on what he thinks the answer always is for any question. So if you're a CRI employee who's listened, you'll probably know what the answer to this one might be. Got the answers coming in pretty well. We're looking at about 50 or 60 of you still need to answer. So I'll give you maybe 5-10 more seconds. Looking pretty good. All right, last call for any answers. Again, this is required for CPE credit to get your certificate later. All right, I'm going to go ahead and end the poll. It looks like 77% of you got the right answer, which is all of the above. So well done, and we'll go ahead and move forward.
April. Next slide, if you would. Probably relatively few of you deal with derivative instruments or lease contracts that reference the London Interbank Offered Rate, LIBOR, or any other IBORs. So I'm just going to nutshell this, and still, even though it'll only take a couple of minutes, it'll be a couple of minutes more than any of you really want to know about this subject. LIBOR and the other LIBORs are going away. for a variety of reasons. So GASB issued Statement 93 to provide exceptions to Statement 53's hedge termination provisions and Statement 87's lease modification requirements. The exceptions allow governments to replace LIBOR or another IBOR with a new reference rate, but still continue hedge accounting or not have to account for a lease modification. Statement 93 also removed LIBOR from Statement 53, which treated it as an appropriate reference rate for interest rate swaps related to taxable debt. And that portion of 93 was to be effective as of the announced sunset date of LIBOR, which was December 31st, 2021. So I'm going to tell you a little story. While GASB was working on that statement, they asked the bigwigs who were in charge of this transition, is there any chance that that sunset date is going to change? And those people swore up and down, no, it's hard as concrete. It is never going to change. The sunset date now is June 30th, 2023, 18 months later. And there have been some rumblings that LIBOR's administrator might continue to publish something called LIBOR, but with a more acceptable methodology. So Statement 99 is the fool us once, shame on you, fool us twice, shame on us kind of approach. Instead of pegging the new effective date for LIBOR no longer being an appropriate reference rate under GASB standards to the date when LIBOR ceases to be, that June 30th, 2023 date, what Statement 99 says is that that effective date should now be when LIBOR ceases to be determined using the methodology that was in place as of the original sunset date of December 31st, 2021, which at least for now is that June 30th, 2023 date. And because that could be fluid, the GASB has said that it will keep stakeholders apprised of when LIBOR no longer is acceptable for hedging derivative instruments. Next slide. It has been a while since food stamps were actual physical stamps, which is what the relevant guidance in Statement 24 is geared toward. States have long since moved to using EBT to administer what is now called the Supplemental Nutrition Assistance Program, or SNAP. So Statement 99 really just reflects practice by superseding that part of 24 in favor of the non-exchange transaction guidance in Statement 33, which is what governments have been applying for some time now. Statement 62 requires that governments disclose the basis of accounting used to determine the value of assets that are obtained in a non-monetary transaction. And so governments quite literally have been disclosing accrual, which is not the intention of that disclosure requirement. What it was really looking for was for governments to explain how they valued the assets, what measurement attribute they used. So Statement 99 amends that disclosure requirement to clarify that governments should disclose the measurement attribute that they applied, such as acquisition value or fair value. The last item on this slide addresses certain transactions that occur between a primary government and a blended component unit in order to avoid double counting when that component unit is rolled up into the primary government's financial statements. Next slide. So nobody's perfect. Mistakes are sometimes made, typos exist, errors are not fixed, items that should have been changed are not changed because they weren't found. And so it's not unusual for an omnibus statement to provide, this says clarifications, it really, except for the first one, really ought to say corrections. That first item addresses some governments that have put a total reporting entity column to the right of their discretely presented component units in the government-wide financial statements, and then they dropped the total primary government column, and that's a no-no. The total entity column is optional, but the total primary government column is required in all cases. So this provision of 99 makes that definitively clear. And then the remainder here on this slide is cleanup work in GASB's codification to ensure that consistent terminology is used throughout to be consistent with changes in terminology, for instance, from Statement 63, when the deferrals were introduced and net position was introduced as a term rather than net assets. Next slide. So the items that are effective immediately in Statement 99 are those that don't require any effort by governments or very, very minor effort. Otherwise, the GASB would have provided some lead time to implement them. The lease, P3 and SEBITA guidance has the same effective date as Statements 94 and 96 on P3s and SEBITAs, so that they can be implemented at the same time rather than implementing those statements as is and then subsequently changing it to address this new guidance. More time is given for the guidance on financial guarantees and derivative instruments, although neither one of them is truly new to governments and shouldn't be tremendously difficult to apply. As always, earlier application is encouraged by the GASB and may be done by individual topic in Statement 99. Normally, if a government is implementing early, it has to implement the entire statement simultaneously. Next slide. Another poll question.
All right, we're on to poll question number 3. This poll question, I'm going to go ahead and launch it while I read it to give you a little more time. What is the new category of derivative instruments under statement number 99? Number 1, ineffective hedging derivative investments. Number 2, effective hedging derivative investments. Number 3, other derivative investments. Or the last choice, investment derivative instruments. Sorry, investment derivative instruments. So 1, 2, 3, or 4. We've got the answers coming in pretty quick now. It's great. We'll give you just a couple more minutes to answer. I'm going to remind you incessantly that you have to answer 80% of the questions and stay on for 100 minutes to get your CPE credit. And that the answers don't have to be correct, just answer. Okay, looks like we're slowing down. So I'm going to go ahead and end the poll. And again, 65% of you got the correct answer, which is number 3, other derivative instruments.
Thank you. So in June, as I mentioned before, the GASB approved Statement 100 on accounting changes and error corrections. You can move to the next slide. The existing standards for prior period adjustments, accounting changes, and error corrections was brought into the GASB's codification as is from FASB and AICPA standards. And some of those are over 50 years old now. So that guidance is not particularly difficult to apply if you can understand it. And that's a significant caveat because unfortunately, many people do not. And it's really not their fault. It's not the best written guidance I have ever read. In fact, it may be among the worst I've ever read. It's very difficult to parse. And to give you a sense of how difficult, when I was at the GASB and we were conducting the research that led to this project, I and the other GASB staff really struggled with properly phrasing some of the requirements of Statement 62 just to be able to ask questions about it in the research. And it turns out we were not alone. There were a lot of practice issues that came up in that research with respect to the application of the standards, which clearly could be written more concisely and understandably. So Statement 100 is the result of GASB's effort to address that. Next slide. The statement covers the same 4 categories, though the third is broader than under Statement 62, encompassing changes to or within the financial reporting entity. And then the other 3 categories are the same: change in accounting principle, change in accounting estimate, and correction of an error. Next slide. As under the prior standards, there's a basic assumption in Statement 100 that governments will apply an accounting principle consistently over time. Statement 100 makes explicit that there are 2 types, which I think a lot of people assumed under 62, but it wasn't clear. There are 2 types of exceptions to that principle, which result in changes in accounting principle. The one that it was not previously explicit is the implementation of a new GASB pronouncement. and the other is a government voluntarily changing from one generally accepted accounting principle to a new one on the basis that the new one is preferable. That being said, if a new GASB pronouncement is not applicable to your government or it has no impact on the amounts reported in your financial statements, there's no accounting change to report. The statement also explains what preferable means, and it says that it is an improvement in the qualitative characteristics of the information reported. Those are the qualitative characteristics that are identified in GASB Concept Statement 1: understandability, reliability, reliance, timeliness, consistency, and comparability. Next slide. If a government is initially adopting an existing accounting principle to transactions or other events that are occurring for the first time or are clearly different from prior transactions or events or were previously insignificant, that's not a change in accounting principle. And then the second box on the slide is an example of one of the difficulties that governments have had in applying 62. And that clarification that's provided in Statement 99 is that, to be a change in GAAP, a government has to have been applying GAAP to begin with. And therefore, this situation is a correction of an error and not a change in accounting principle. Some amounts that are recognized in the financial statements or disclosed in the notes are the products of accounting estimates. You plug inputs in, such as data and assumptions and methodology, measurement methodologies, and accounting estimates pop out on the other side. So a change in accounting estimate is when you use different inputs because circumstances have changed, or you have different information, or because you have more experience. If the change in accounting estimate results from a change in measurement methodology in particular, the new methodology should be preferable to the old ones. Examples that are provided in the statement of changes in measurement methodologies include a change in depreciation method and a change in the technique for measuring fair value. It's important to note one other thing too, and that's that a change in accounting estimate could be changing the source of data, say swapping CPIW for CPIU as an inflation assumption, but changes in the amounts from year to year are not changes in an accounting estimate. For most assumptions, especially that relate to rates or indexes, one would expect those amounts are going to change from year to year. Next slide. So this is the most significant revision to the 4 categories. And it's based on users considering changes within the financial reporting entity being important, as well as organizations being added or removed from the reporting entity in terms of them being able to consistently track financial information over time. So this category now includes when a fund is added or removed as a result of moving continuing operations within the primary government. But I should mention, most other more routine additions and removals of funds would not be considered a change within the financial reporting entity. It also includes a change in a governmental or enterprise fund from major to non-major or vice versa, and a change in the method of presenting a component unit from discrete to blended or blended to discrete. Next slide. The 4th category, correction of an error, its description is largely unchanged from Statement 62, what you're seeing on this slide. To address stakeholder concerns about being able to differentiate a change in accounting estimate from a correction of an error, Statement 100 clarifies that changes in accounting estimate result from new developments. So different circumstances, new information, more experience. Whereas on the other hand, errors occur when a government should have known facts about conditions that existed as of the date of the financial statements. And hopefully that clarification, which obviously is expressed in more detail in Statement 99, will help to resolve that problem in practice. Next slide. Another poll question.
All right, poll question number 4. We just talked about some of the different kind of changes that are covered by Statement 100. So we're going to see what you guys think. What type of change to the financial statements is not covered by Statement 100? Is it correction of an error, change in accounting principle, change in font, or change in accounting estimates? Plugging away, these answers are coming in fast and furious. About 5 seconds left to get everybody in. 80% have to be answered to get your CPE credits. I am excited about this new standard. I think it's going to give us a lot of direction. There's still a little bit of wiggle room and some of the definitions, but I think we've got more than we have today, so it'll really help us. All right, we're going to end the poll. Last second, and yes, 91% of you got the correct answer, which is change in font. Oh, I'm sorry. Yes, change in font is the one that is not covered. Yes, sorry, my brain was not working with that answer for just 1 second. Oh, yes, so obviously change in font. You feel free to do that anytime. We don't need a GASB standard to help us with that. All right, let's keep moving.
Thank you, April. One of the sources of confusion in Statement 62 that I think Statement 100 does a great job of illuminating is what is required for financial statements covering a single year, which is what the vast majority of governments prepare, versus for comparative financial statements. So a lot of those references to prior period adjustments are irrelevant to most governments because there's no prior period in their financial statements. In my opinion, the only moderately challenging aspect of the old or new standards really is dealing with financial statements that have both a current year and a prior year. Otherwise, I think the standards are very straightforward. In the case of either a change in accounting principle or change in accounting estimate, it's possible that a GASB pronouncement may include specific transition provisions, but if not, the general approaches in Statement 100 should be followed. And that's something I will come back to a little bit later to talk about. So what that means is beginning net position and fund balance should be restated for the cumulative effect of a change in accounting principle, whereas for a change in accounting estimate, they should be reported prospectively and not by restatement. And though the reporting entity category has been broadened from Statement 62, I think the burden of the accounting requirement is lessened by Statement 100 because only the current reporting period's beginning balances need to be restated, whereas Statement 62 required that the prior periods be restated as well. And lastly, the requirements for an error correction are the same as the general approach for a change in accounting principle. Next slide. Now governments have the option to show the amounts of restatements of beginning net position, fund net position, or fund balance as appropriate on the face of the financial statements, or on the face to simply show the restated beginning balances and label them as restated and disclose the restatement amounts instead. Statement 100 requires that the aggregate amounts of the restatements be displayed on the face of the financial statements. There no longer will be a disclosure option, and that's the kind of change you can expect to see from the GASB based upon its conceptual framework, which concept statement 3 on communication methods very clearly states what constitutes information that can be recognized in the financial statements versus disclosed in the notes or presented in RSI or SI, and it can't be both. And based upon the importance to users of being able to easily see the amounts of these adjustments and not having to go find them in the notes, the board's conclusion was that they ought to be on the face of the financial statements. Next slide. Speaking of disclosure requirements, Statement 100's disclosure requirements are largely the same as for Statement 62, with 2 new features. First, for all but changes to or within the financial reporting entity, the line items in the financial statements that are affected by the accounting change or error correction should be disclosed, excluding totals and subtotals. And the periods affected by the error correction should also be disclosed. And then second, the disclosure of the amounts of restatements or adjustments of beginning balances should be presented in a tabular format. And I'll say more about that in a moment after the next poll question. Well, let's go back for 1 second. I think I have that one last slide before the poll question. I'm sorry, I didn't say change the slide. Some changes in accounting principle or error correction may not affect beginning balances, but they still result in a reclassification of items in the financial statements. And in those instances, Statement 100 requires very similar to disclosures for changes in accounting principle and error corrections that result in a restatement or adjustment of beginning balance, but they're fewer really than what is required for restatements of beginning balances. Now I think we're ready for the next poll question.
All right, we'll go ahead and launch it. Poll question number 5. Which disclosure is a new disclosure under statement number 100? Which one is new? The nature of the change or error and correction, the effects on beginning balances in tabular format, the reason for the change, or the reason why the change is preferable. So we know we need all of them, but which one of these is a new disclosure? About half of you have answered. We'll kind of give you another 15 seconds or so. I'm starting to slow down just a little bit. Okay, we'll put this the 3 to 5 second warning. Okay, and I'm gonna close the poll. So get those answers in right now. All right, it was not as distinct, but we still have 40% of you with the right answer, which is number 2. The effects on the beginning balances in tabular format. That is a new disclosure under statement number 100.
Thank you, April. So this is taken from statement 100, one of 2 illustrations that are in there of what the tabular format, the tabular disclosure of restatements and adjustments might look like. For each change in accounting principle, change to or within the financial reporting entity or error correction that occurred during the period, this table should reconcile the beginning balances as previously reported with the beginning balances as adjusted or restated. The table should be organized by reporting unit, which is why you see the columns from each of the financial statements. In this illustration, the governmental funds and the fiduciary funds really don't need to be there because they aren't affected by the assumed accounting changes and error corrections in the illustration, but they're included here for illustrative purposes. One of the objections that was raised by some respondents to the proposed version of the statement was that they shouldn't have to present a table if they only have one or a couple of accounting changes or error corrections. And if that's true, then they probably will be showing the restatements or adjustments individually on the face of the financial statements rather than aggregating them, in which case they don't have to disclose the amounts at all because they're already shown on the face, let alone to present them in a table. So in fact, they were right, but not for the reasons they thought. Next slide. This is the other illustration that is in statement 99. It's the same exact set of assumptions, but they've swapped the rows and columns from illustration 1. And you can see here that the governmental and fiduciary funds have been left out. And so it makes for a somewhat more compact presentation, but all of the information is exactly the same as what was presented in illustration 1. Next slide. Statement 62 didn't address how to reflect accounting changes or error corrections in required supplementary information, such as management's discussion and analysis, or MD&A, or the pension schedules, or in supplementary information such as combining statements of non-major funds, or the statistical section schedules, because it wasn't written by the GASB, for one thing, and because it predated those requirements that the GASB established. So Statement 100 does take this on, and it requires that the effects of changes in accounting principle and changes to or within the financial reporting entity should be reflected in RSI and SI for just the same years that are affected in the financial statements. In other words, for the vast majority of governments, we're talking about just the current period. Earlier periods, in fact, should not be restated or adjusted, only the periods that match the years that are presented in the financial statements. There may be a need to present an explanation if the current and prior years are not consistent as a result of an accounting change. And if that's true, then that explanation in MD&A should include a reference to the related note disclosure. With respect to error corrections, they should be addressed for all affected years in RSI and SI, not just the periods in the financial statements. And that's because the GASB's position is that governments shouldn't knowingly report incorrect information. However, in response to feedback that it got on the exposure draft of the proposed statement, the GASB did ease these requirements somewhat by providing a practicability exception for error corrections in years prior to those in the financial statements. If it's not practicable to correct the error in some of the years in RSI or SI that were affected by it, then a government should label the information as restated or not restated. And the last thing I'd say about this is whenever the topic of practicability comes up, other than laughing at my inability to pronounce it, I always make a point of emphasizing what the GASB says about it, which is that practicable is a very high bar, and it's much more than just hard to do. Next slide. Statement 100 is effective for fiscal years ending June 30th, 2024, August 31st, September 30th, December 31st, 2024. And as usual, the GASB encourages earlier application. Next slide. The last two things I wanted to share with you with respect to Statement 100 are not written in the standards within the statement, but they were changes in policy that the GASB made while it was deliberating over this statement. The first is a change to the default language of effective dates from periods beginning after June 15th or December 15th to fiscal years beginning after June or December 15th for a particular year and all periods thereafter. So under the old default language, governments that prepare quarterly financial statements or financial statements for other interim periods would have to first implement for that interim period if the language periods beginning after was how the effective date was stated. And that's earlier than any other government, and most governments don't prepare quarterly financial statements on a GAAP basis. Under the new language, every government will implement for the first time for a full fiscal year. And that new language you can see reflected in the effective dates for 99, 100, and 101. The second thing is a change to the default approach to transition guidance in GASB pronouncements. Going forward, instead of fully spelling out the guidance, which tends to be exactly the same in most pronouncements, going forward, statements will and other pronouncements will reference the relevant accounting and financial reporting guidance in Statement 100, unless the GASB believes there's a good reason to approach transition differently from what Statement 100 requires. And that change was first reflected in Statement 101, which Yvonne is going to tell you about after this next poll question.
All right. Thank you, Dean. Poll question number 6. We'll go ahead and launch it. what information about accounting changes or error corrections was required in RSI or SI prior to statement number 100? Was it a requirement prior to statement 100 to restate all prior periods presented, to explain the nature of the error, or a restatement of all periods presented in the financial statements? Or was it none of the above? So prior to statement 100, prior to implementation, what did you have to disclose in RSI or SI? Reminder, 80%. And while we're giving some time to fill this out, a question came in through the Q&A asking about what the materiality threshold of an error correction would be that would require restatement of beginning balances. And I'll let Dean and Yvonne speak to that as well. But generally, it's really generally it's an auditor judgment on that kind of a materiality based on the opinion units that can be qualitative and quantitative. So I don't know, Yvonne and Dean, do either of y'all have any more input into what that materiality level would be for an error correction, any kind of guidance or a rule of thumb?
Not generically, no. You're never going to see that in the GASB statement because GASB doesn't determine materiality. As April said, that's a matter that you discuss with your auditor, and that's where you're going to determine it. But I can say that like all GASB statements and all GASB pronouncements, they are only applicable to material items. Every statement makes a point of saying that in what's called the materiality box. And therefore, if you're dealing with immaterial items, you don't have to worry about applying these standards to them.
Yeah, and I concur. And April made a good point. It's not necessarily only quantitative. We have to look at the qualitative factors as well.
Yeah, it's a great time to loop your auditors into the discussion if you think you have something like that you need to address, both in whether or not it is material, reaches that threshold. And again, it'll be based on those opinion units. And then you really, get their guidance on how to implement it to begin with once you get 100 in. Just make sure you're all on the same page. It's always good advice to use your auditors as a teammate in these sort of unusual situations. So we'll go ahead and close the poll. And so 43% of you got the answer none of the above, which is the correct answer. Prior to the implementation of statement 100, none of those things had to be in RSI or SI. So we have some new, it's a kind of a good question to highlight, but this is definitely something new that we'll be looking at seeing once we get the statement implemented.
Okay. And with that, we'll move on to statement number 101, compensated absences. Okay, so the existing standards on compensated absences have been around for about 24 years. So kind of think of statement 16 as a fine wine. It's at this point starting to turn to vinegar. So it's time to put the bottle down. So the GASB decided to re-examine the standard and looked at the variation and how the standards were being applied and the inconsistencies on the treatment between certain types of leave. So because of those inconsistencies and because the new conceptual framework, which is almost complete now, makes the optionality with respect to recognition and measurement almost impossible, it was time to address some of the things related to compensated absences. For instance, if you have an asset, it's either going to be an asset or it's not going to be an asset. It's going to be a liability or it's not going to be a liability. So under the new conceptual framework. So treating vacation leave and sick leave differently, as well as having different ways to measure and recognize sick leave, is inconsistent with the new GASB concept statements. So statement 100 effectively views all leave as being the same if it meets the recognition criteria that we're going to discuss shortly. So unlike 16, statement 101 addresses leave that has been used but not yet paid for. So you might have leave that's accrued, but the fiscal year ends in the middle of a pay period. And so you have that liability for that portion that's accrued at that point in time. So the statement requires the recognition of a liability, but leaves it up to the governments on how to decide to label it or where to show it in the financial statements. So there's a general approach to recognition. So the lowering of the threshold is going to result in more leave being reported as a liability. On the upside, because they use the more likely than not measurement, it's easier to evaluate than probable and is hopefully going to be more comparable across governments. So with statement 16 under the old rules, you could either use the vesting method or the termination method for accruing sick leave. But in statement 101, there's only one method and it applies to all forms of leave. So there's no more option as how to apply leave. So sick leave and restricted sabbatical leave. Restricted sabbatical leave is that, when you have sabbatical leave where someone is moving, for example, from a teaching position to a research position, that's restricted sabbatical leave. Unrestricted sabbatical leave is somebody leaves and has no work responsibilities assigned with that sabbatical leave. But sick leave and restricted sabbatical leave could be viewed as meeting the description for leave that depends on the occurrence of a sporadic event that affects a relatively small portion of employees, such as parental leave, military leave, or jury duty. But the statement 101 explicitly states that they should be sick leave and restricted sabbatical leave should be accounted for using the general approach that we've just discussed. So parental leave, military leave, and jury duty should always be recognized. And so there may be other examples such as bereavement leave that fall under that sporadic event criteria. If you have leave that's settled through a conversion through a defined benefit plan, whether it's pension or OPEB, that should not be recognized as a liability for compensated absence. So when you have leave that's been used, you're going to recognize a liability for the cash payment or non-cash settlement payment that's going to be used to made for that leave, including any salary related payments, which could potentially include defined contribution payments. And with that, we have another poll question.
All right. Go ahead and launch it so you guys can get started. Under statement 101, when should a liability for leave be recognized under this new standard? Should it be recognized when leave is attributable to services rendered? When leave accumulates? When leave is more likely than not to be used, paid, or settled? Or is it all of the above? I know the splitting out of sick leave from vacation leave and compensated absence calculations was always one of those very nuanced sort of things when we were learning how to do governmental accounting. So this is a pretty big change coming to us. And I've been doing governmental accounting for very many years. And so having a new standard for that is kind of nice to have some very clear guidance on how we're going to be recognizing this. We've got about 89% of you have answered. A reminder, if you'd like CPE credit, you've got to answer at least 80% of these questions. They don't have to be right. All right, we'll give you like 2 more seconds and then we're closing the poll. So squeeze in those last answers.
Hey, April, I just realized there's a typo in I think it's slide 51, one of the earliest slides for statement 101. It says that a liability should be recognized. There it is, for leave that has been used. That should be leave that has not been used, which is what has always been recognized as part of the standards for compensated absences. And then the second bullet is leave that has been used but not yet paid or settled.
Right. All right. Thanks, Dean.
Apologies for that, everybody.
All right, so we'll go ahead and end the poll now, and 77% of you got the correct answer, which is all of the above, number 4. This is when we recognize our leave liabilities under 101, when the services, it's attributable to services that have already been rendered, it accumulates, and it is more likely than not to be used, paid, or settled, as Yvonne emphasized earlier.
Okay, thank you, April. So we have the measurement of the liabilities for leave that's been used and not used, but it needs to include those salary related payments that I mentioned previously. So those are those that are directly associated with the leave, dependent upon the salary that's about to be paid, and then the incrementally associated with the leave. So those payments, in addition to the payment of the salary, and I previously mentioned, it could be Social Security and Medicare taxes. It could be employer payments related to DC pension plans. It depends on what your compensation formula is with your government. So again, you need to look at it. So it excludes those defined benefit pensions and OPEB, but everything else is fair game for consideration. So what is that general measurement approach that we talked about? So you're going to look at, and this is not unlike what's done in most cases already. You're going to look at that liability. You're going to look at that accrued leave, typically based on a number of hours, and you're going to measure it using the employee's pay rate as of the date of the financial statements. You're going to look at leave more likely than not to be paid at a rate different from an employee's pay rate, should be measured at a different pay rate. So if you have a policy that says that an accrued leave balance is going to be paid at 50% of the employee's highest pay rate, again, that should be what's being measured. Then you're going to look at leave not attributable to a specific employee, because in the feedback that the that the GASB got, they were asked to address leave pools. So the statement specifically says that if you have leave not attributable to a specific employee and as part of for example, as part of a shared employee leave pool, the government's going to measure the liability using an estimated pay rate that's representative of the employee population, the eligible employee population. So if it's only for non-executive level employees or non-management level employees, you would come up with a representative pay rate of the eligible employees. Okay. And then you have, for the leave more likely than not being paid at a different rate. If you have again, I talked about a leave policy that compensates departing employees at 50% of a pay rate. And again, if it's more likely than not to be settled by non-cash means other than the conversion to a defined benefit plan, it should be based on the amount that's more likely than not to be settled. Which brings up most often you have employees, if you have sick leave that's completely separate from other leave balances, and you have an employee has a very large sick leave balance because they just never get sick. Again, part of that consideration is it more likely than not that sick leave balance will be used by that employee. Okay. So we have accumulated leave that meets the recognition criteria. You're going to multiply that by the employee's pay rate as of the financial statement date, or if it's at a rate something other than the employee's financial statement or financial rate at the financial statement date, whatever that rate may be. And then you're going to add in any salary related payments. And, often you see that it's usually limited. A lot of the calculations take into account Social Security taxes, but you want to look at other taxes as well and other salary related payments. You're going to disclose in the long-term liabilities note some of the relief that was provided as part of this standard is you can elect not to indicate the additions and the increases and decreases as separate numbers. You can use a net number and take your compensated absence beginning balance and your compensated absence ending balance, show the change as a net amount. as long as you've indicated that it's a net amount. You do still have to estimate that portion of the ending balance that's going to be due within 1 year. So that's not eliminated under statement 101. But again, that trying to figure out what went in and what went out, and separately report that, you have some relief there if you should choose to use it. You're going to still disclose the governmental fund used to liquidate. The disclosure for which of the governmental funds is going to be used to liquidate the compensated absence liability is no longer required. It's one of those rare instances where we actually got the elimination of information in a footnote. So take advantage of it when you get it. Okay, so when is this effective? It's effective for those fiscal years beginning after December 15th, 2023. So your December 31st calendar year ends or your 2025 fiscal year ends. And then at transition, you can report this as a change in accounting principle in accordance with statement 100. And with that, we'll move on to our next polling question. April?
All right, poll question number 8. Under statement number 101, which is not a component of the measurement of leave liability? What is not going to work into that measurement? Number 1, the employee's pay rate at the date of the financial statements. Number 2, the number of days of leave accumulated. Number 3, non-cash defined benefit pension or OPEB. Or number 4, salary related payments. Which one of these 4 do we not consider when we're measuring that leave liability for compensated absences? Got about 75% of you have your answers in already. Awesome job. Let's keep them rolling. Give you another maybe 10 seconds to get everybody in.
And while we're waiting, we do have a question that whether or not there was a change in guidance on whether to consider leave liability current versus long-term. I believe I covered that in the last slide, but just to clarify, yes, you still need to estimate that portion that's going to become due in the next fiscal year. So that current portion still needs to be estimated under the new standard.
All right, thank you,
And if I said that wrong, Dean will jump in.
No, you're right. The guidance with respect to calculating the current portion of any long-term liability is beyond the bounds of statement 101 or any other individual statement, and none of that was addressed. So in order to present and recognize in the financial statements, you still have to calculate the current portion, and the statement 101 does require that amount be disclosed in the long-term liabilities note.
All right. So April, we got the poll closed.
Yep, got poll closed, and 69% of you had the right answer. That non-cash defined benefit pension or OPEB portion of any kind of accrued leave is not going to be a component of that accrued compensated absence long-term leave liability calculation.
Okay. Fantastic. So now we're going to be talking about the statements that are now being implemented or implemented in the very near future. There were some difficulties about differentiating service concession arrangements from other P3s. But the key is that the SEA has it only applies if there's 4 specific criteria that are met. And the one that's often different for service concession arrangements from other P3s is the government transfer having the ability to dictate what services are provided by the operator, to whom the services are provided, or how much can be charged for the services. And I know there's a lot of confusion when we first started looking at 87 for some clients that, they started looking at some of the agreements and said, well, maybe I have a service concession arrangement. And so we had to go back to that standard and look to make sure whether or not that 4 criteria was met. So the one that when you start talking about P3s of the other 4 criteria that the operator collects fees directly from the customers is that primary difference between service concession arrangements and many of those availability payment agreements or APAs, which are also covered in GASB 94. So at this stage, most of you have already started implementing GASB 87, hopefully getting close to being done with that. So we're just going to give a quick review, give you an opportunity to ask some specific questions if you have them. But we're going to present 87, 94, and 96 together because they're some very similar similar ways to approach the implementation of these three standards. So they share a common basic approach. So we wanted to show that here. Again, with the leases, you have an intangible right to use asset. You've got a liability that's going to be equal to the present value of the payments. And then you're going to amortize that intangible asset and that interest expense over the life of the lease. So with your P3s, again, you may have an existing asset, which again becomes an intangible right to use asset, or you could have a new asset, which becomes a P3 asset until the ownership is transferred. You have a liability for installment payments to be made. Their deferred outflow is measured at the estimated carrying value of the future date as of the future date of the transfer. And again, you're going to have amortization of that asset or depreciation of the new asset. So SBITAs on those subscription-based information technology arrangements, again, is very similar to the lease approach, where you'll have that intangible, and then you're going to have a liability equal to the present value of those subscription payments with amortization of that asset and interest expense reported on your statement of changes. So this slide, there was a small typo on it here as well, which should be referencing statement 94 instead of 96 for the P3s. Again, the lease statement, we're just going to talk about the lessor and transfer accounting, which doesn't bring into account, it's not analogous to statement 96 for SBITAs. But again, with the assets, you've got deferred. If you're a lessor, you have the lease receivable, you have a deferred inflow, and you recognize revenue over the lease term. And then you still will be reporting the depreciation expense of the asset because that stays on the books under GASB 87. For the P3s, you're going to have a receivable for that installment payment, and then you're going to have a deferred inflow for the assets being recognized, and then revenue is going to be recognized from over the P3 term. So what is that subscriber term? And probably the most questions we get is about what is the lease term. So we want to talk about putting in an example here and have you illustrate some things to consider when you talk about the lease term. So when you talk about determining the lease term, it's essential to measuring the transaction. So say you, for example, have a lessee with a lease contract that covers an 8-year period. So the first 4 years are non-cancelable. Because they're non-cancelable, they're included in the lease. And then you have that 5th year where the lessee option, there's a lessee option to extend. And it's reasonably certain that the government is going to extend that option. So that's included in the term. Then there's a 6th year in which the lessee has an option to terminate, but it's reasonably certain that that government is not going to exercise that option to terminate, so it's included in the term. In the 7th and 8th years of the contract, both the lessee and the lessor have options to terminate without notice, so those periods are excluded from the lease term. So what if you have a contract that gives either party the right to cancel, but it's highly unlikely that they will cancel because of severe cancellation penalties? So that cancelable period should be excluded. Again, any period in which both parties have the right to cancel, regardless of cancellation penalties, is not included in the lease term. So that cancelable period should be excluded. But what if only the lessee has that right to terminate, and it's highly unlikely that they'll cancel because of severe cancellation penalties? In which case, then the cancellation period should be included in the lease term. Right now, it is presumed that this guidance is going to be made available to the P3s and the CBITAs, as well as how it's applied to GASB 87, because this comes from the implementation guidance for GASB 87. But again, you need to look at the overall guidance. It's designed to be analogous between the P3s and the CBITAs. So until the GASB specifically makes implementation guidance that contradicts it, you should use this same basic approach. And with that, I have another poll question.
All right, poll question number 9. Which of the following types of contracts does statement number 87 apply to? So we're talking statement 87 only. Does it cover leases? Does it cover P3s? Does it cover the terrifying and exciting CBITAs? Or is it all of the above? CBITAs is subscription-based information technology agreements. Right. You guys are doing a great job coming in quickly. We'll give you another 10 seconds or so to get this in. But which types of contracts does statement 87 only apply to? All right, last 5 seconds. Last call for answers. All right. So the majority of you got this one correct. 87 is leases only. So 87 and leases are combined for the right answer.
Fantastic. Okay, so a little bit about short-term leases and CBITAs. When you look at a lease contract, you first are going to look at the maximum possible term, and that's distinguished. It's different than the lease term. And the reason they made that distinction is the GASB was concerned about the potential misapplication of that lease term guidance. So for people to go out there and manufacture short-term leases to avoid recording of the liabilities. So again, the guidance was written in such a way that you have to actually consider the maximum possible term in identifying short-term leases and short-term CBITAs before you go into the exercise of looking at the lease term. So if you have a short-term lease, by definition, is at the beginning of the lease or the subscription period, that maximum possible term under the contract is 12 months or less. So you would recognize expenses or expenditures based on the terms of the contract, no differently than what you're doing right now. And again, with the lessor, same thing. You're going to recognize those lease payments as revenue based on the payments coming in on the contract. You're not going to recognize receivables or deferred inflows in advance. Obviously, if somebody's late on a payment, you're going to record a receivable. But again, the timing is going to be, the accounting is going to be the same as what you're currently doing for operating leases. So here's a couple examples to provide some clarity. So you have a government that enters into a 12-month non-cancelable contract with some options to renew for 12-month periods up to 49 times. Is this a short-term lease? Well, in this case, no, because those presence of those renewal options is going to become part of the maximum possible term. And at that point in time that the maximum possible term exceeds 12 months, then you have a long-term lease. It no longer, it qualifies for treatment as a short-term lease. Another example is you have a 6-month non-cancelable contract with an option to renew for 12 months. It's not reasonably, the government's not reasonably certain it will exercise the option. So whether, is this a short-term lease? Again, in this case, the maximum possible term exceeds 12 months. But the lease term for purposes of measuring the liability is only 6 months. So there's your distinction. So you have that maximum possible term. So that makes it a long-term lease, regardless of the fact that it's only going to be used for 6 months. So when you measure the liability, you're going to use the 6-month criteria. Okay. You have a 3-year contract where both the lessee and the lessor have a right to cancel within 60 days notice. So in that case, the non-cancelable period is that 60 days, in which case you have a short-term lease, even though you have a 3-year contract. By the same token, you have a 12-month contract with a lessee option to renew via a new lease contract. So you're not going to renew the same lease contract. There has to be a whole new contract issued at the end of that 12 months in order to continue with that transaction, in which case the 12 months is the maximum possible term because it's based on the individual contract. So if your lease contract is replaced with an entirely new lease contract, they're looked at as 2 separate contracts for purposes of this measurement. So you have a 12-month contract with no option to extend, but the lessee has signed a new lease every year for the past 20 years. Well, that still doesn't matter whether or not there's a likelihood that that new lease is going to be signed based on that historical action of renewing the lease. So in this case, that's not relevant and you have a short-term lease. Did I see a question come in? Oh, it's gone now. So you have contracts with lease and non-lease components. So what do? You're going to have to try to separate them out and treat them as separate contracts and allocate the contract price. And hopefully it's clarified in the contract, but it's not always clear. So if you have a contract that has multiple underlying assets, so you have, say, maybe a building and an equipment lease, and they're combined into one lease contract, but they're different assets in terms of the period of time that they're going to be made available for you. Again, you're going to want to account them as separate contracts to the extent you can and allocate the contract price. If it doesn't include the allocation of the individual components or the prices appear unreasonable, then you need to use your best judgment for allocating the contract price. As your auditor, I'm going to say when you come out there and you start saying, okay, well, this is what I truly believe, again, just provide your auditor some basis for how you arrived at that conclusion, so that we know you just didn't pull a number out of the air, even though we know you don't do that, but we want to make sure, in audit terminology, if we can't see it, we can't audit it. So make sure you're retaining your documentation on how you arrived at that estimate. And again, if it's not practicable, you can account for those components as a single lease. And as Dean mentioned, not practicable doesn't mean it's hard to do it. It's a much higher threshold. Just because it's challenging and difficult doesn't mean it's not practicable. So what if you have a component of a lease that's excluded from the scope of 87 and the other is not? For the portion that is within the scope of the lease, you're going to only going to account for that portion that is GASB 87 eligible. Dean, I'm trying to come up with an example, and I had it and I lost it. Do you have a quick example?
Not off the top of my head. Let me just think about it for a second.
Okay, we'll come up with this in a second. So if you have a government that's a lessee for 2 floors of an 8-story building, and part of those lease payments are for utilities and janitorial costs, to the extent that it's practicable to do so, you're going to separate out those utilities and janitorial costs. So you're only dealing with the lease component portion under GASB 87. Okay, so what about those options to terminate? So under leases, P3s and SBITAs, if you have an option to terminate, that's an unconditional right. The right to terminate due to that's that option to terminate. But if you have a right to terminate due to action or inaction, that's not considered an option to terminate. So if you have a lessor that isn't making lease payments, your right to terminate under that option is not a right to terminate for purposes of identifying that maximum possible lease term. Again, for leases only, the option to purchase, the underlying assets should be considered an option to terminate for measuring the lease term. Again, because at that point in time, it becomes a finance purchase, not a lease. For short-term leases and subitas, modified short-term leases or subitas should be remeasured from the inception of the lease or the subita. So you have a short-term lease and the lease contract's modified. And at that point in time that the lease term gets modified, that extends it to what would have been a long-term lease, you're going to go back and remeasure from the inception of that lease or subita to come up with that new accounting treatment. As Dean mentioned previously, you are not going to remeasure solely for the change in an index or rate that's used to determine variable payments. If that's the sole thing that's changing, that's not what you're not going to remeasure. Now, if you have other factors that come into play that require remeasurement, and you have a change in the index or rate as well, you can remeasure based on both at that point in time, but it can't be the sole reason that you're doing the remeasurement. Poll question.
All right, well, on poll question number 10, we're getting close to the end. Go ahead and launch it. What topics are covered by the implementation guides? Is it short-term leases, leases with multiple components, lease term, or the ever popular all of the above? Make sure to get your answers in so that we can get you your CPE credit. We got about 85% of you have answered. I know everyone watching, not everyone watching needs CPE, so we won't get to 100, but we will hopefully get close. Give you another 5 or 10 seconds. We did have a question just come in.
Okay.
So Yvonne and Dean, if both parties have the right to terminate with 180-day notifications, is that the scope of the agreement and term, even if I am reasonably certain both parties will continue beyond 180 days? So they both have the right to terminate, but reasonably certain that they will both continue.
So in that case, your non-cancelable period is the 180 days.
Because both parties have the right to terminate.
Right. Assuming that the previous period is cancelable. In other words, if I have a 12-month lease with 180-day notification to cancellation, then my non-cancelable term is the 180 days, regardless of whether or not you're reasonably certain that either party will continue beyond.
All right, let's go ahead and end the poll. And we had 95% selected the correct and very popular answer of all of the above. All 3 of these topics are covered by the implementation guides.
Okay. Fantastic. And a topic near and dear to my heart, let's talk about 457 plans. So on 457 plans, back when the GASB originally issued statement 32, there was no option under the IRS code for employers to contribute to 457 plans. That has since been changed, and now employers are allowed to make contributions. So the question becomes whether or not Section 457 plans are pension plans. So there was the existing blanket guidance that no Section 457 plans were pension plans is no longer correct. So it's not a blanket definition. So users do not consider the reporting of defined contribution plans as fiduciary funds to be valuable as it is for defined benefit plans, was a common comment that GASB got when they started looking at this information, the new standard. So if you have a 457 plan that meets the definition of a pension plan, so are the contributions being made to the plan? Are they irrevocable? Are the plan assets dedicated to paying benefits to members? And are those plan assets protected from creditors? And that's kind of abbreviated version of the definition of a pension plan. And then the government's providing benefits through that section 457 plan that meets the definition, it should be accounted for under GASB 68 or 73. But if it doesn't meet that definition, then it's another employee benefit plan. So the new standards are allowing that you need to evaluate whether that 457 plan meets that criteria. Once you've established that it's a pension plan, you need to evaluate whether or not that 457 plan meets the criteria to be reported as a fiduciary fund. If you do, then you're going to value investments as of the end of the reporting period. And that's eliminating the option for the use of the most recent report of the plan, which may or may not coincide. Okay, so we talked about the DC contribution pension and OPEB plans that were excluded from the component unit criteria based on if the government is performing the duties of the governing board in the absence of a board. It is the same as appointing a voting majority of the board. And then the provisions that consider a government having a legal obligation or assuming a legal obligation to make contributions as being a financial burden. Because there was some consideration when the new standards came out that DCs were all going to get categorized as component units under the existing criteria. So the GASB clarified that DC plans are excluded from that component unit criteria just based on those two criteria. Okay, so the implementation date of this is effective immediately, and then effective for fiscal years beginning after June 15, 2021 for the provisions related to the DC plan, or sorry, the section 457 plans. And again, I'm all about making it easy. So in my mind, if you have a 457 plan and your government is not making contributions to it, again, you're looking at it very much like the other DC plans. And you're probably not going to meet the criteria for fiduciary component. But if you have a government that is making contributions to a section 457 plan, again, you have to go through the exercise of, does it meet the definition of a pension plan? And if it does, you need to go through the exercise of evaluating whether or not it meets the criteria to be reported as a fiduciary fund. So it may meet the criteria as a pension plan, but not meet the criteria to be treated as a fiduciary fund, but it would be reported in the disclosures as a pension plan. And this, I believe, is getting us to our final poll question. Oh, no, we have one more after this.
Yep, we are on poll question 11 of 12. So go ahead and launch it. Which of the following statements is correct? All section 457 plans are pension plans. No section 457 plans are pension plans. Section 457 plans that meet the definition in statement 67 are pension plans, or none of the above. So are they always pension plans? Are they never pension plans? Are they sometimes pension plans if they meet the definition in statement 67, or are none of the above true? And we've got about 82% of you have participated. We're getting close to the end, so let's make sure we finish strong and get your 80% of these questions answered so we can get you your credit. Close the poll in about 5 seconds. We can, all right, I think we're good. All right, we're going to end the poll. And 72% of you had the right answer, number 3. That some section 457 plans will be pension plans if they meet the definition in statement 67. So there we go, something to assess.
All right, and Dean, take us to the home stretch.
You go to the next slide. We do want to spend some time, if we have it at the end, to answer more questions if you have them, if you want to submit them to us. And with the remainder of the time prior to that, very quickly touch upon 4 other statements that are being implemented at present. So prior to Statement 89, capital assets related to business type activities or enterprise funds, for those, governments were required to include interest incurred on borrowing prior to the capital asset being placed into service in the amount capitalized in the financial statements for that capital asset. That was not allowed, however, for capital assets related to governmental activities, and that inconsistency doesn't make any sense. There's no reason to do it one way for business type activity capital assets and another for governmental activity capital assets. So Statement 89 entirely eliminates the capitalization of construction period cost, interest cost, and the result for governments should be a reduction in preparation effort. And that's effective for fiscal years ending last December 31st, this past June, or for those of you with September 30th fiscal year ends 3 days from now. Next slide. Statement 91 on conduit debt is the result of a re-examination of Interpretation 2, which was issued in 1995, a fairly long time ago for accounting standards. As with a lot of pronouncements that old, some of the provisions of Interpretation 2 were found to be inconsistent with the conceptual framework that the GASB has established since then, most notably allowing governments to continue to report conduit debt that they issued as their own liabilities. Concept Statement 4 clearly defines a liability as an obligation to sacrifice resources that a government has little or no discretion to avoid, but conduit debt is supposed to carry no obligation for the issuer. The party on whose behalf the conduit debt was issued is the obligor. The second biggest problem with Interpretation 2 is that in practice, governments were all over the place in their application of the standards, perhaps because Interpretation 2 was an interpretation and not a full-fledged statement of its own, and the result was substantial variation from government to government. So to address those problems, Statement 91 clarifies the definition of conduit debt to eliminate a lot of those variations in practice, and it states clearly that no government should recognize the conduit debt it issues as liabilities in its own financial statements. However, as a result of promises a government makes to its conduit in its conduit debt agreements to make debt service payments on behalf of the third-party borrower, or actions the government takes that indicate it intends to make those debt service payments on behalf of the borrower, a government may need to recognize related liabilities for those payments. And the model used in Statement 91 is the same as for financial guarantees in Statements 70 and 99. So the government should recognize a liability if it is more likely than not that the issuer is going to make debt service payments. So it may have a liability for debt service payments it's either required or intends to make, but still, again, not the conduit debt issuance itself. Statement 100 is effective for fiscal years ending December 31st, 2021, June 30th, 2022, September 30th, 2022, and so on. Next slide. So I already told you way more than you want to know about Statement 93 when I was talking about what Statement 99 does with respect to the effective date for the elimination of LIBOR. The one thing I would mention here is to repeat that this statement does not require governments to do anything they don't want to do. It's a lifeline that GASB threw to governments that use LIBOR in their leases or derivative instruments, rescuing them from what otherwise would have been adverse accounting implications. Slide. This is the last one we're going to cover. Statement 98 changes the name of the Comprehensive Annual Financial Report to the Annual Comprehensive Financial Report, or ACFR. Now, I realize that some people wonder why the government spent time, why GASB spent time doing this, but it was something that GFOA and some individual stakeholders asked the board to consider to change this name, because the prior name, it's the common pronunciation of its acronym CAFR sounds like a profoundly offensive racial slur that's used in South Africa. So offensive, in fact, that South Africa passed a law after apartheid ended prohibiting its use and making it a crime to use that slur. And I think given the GASB's commitment with its parent organization, the Financial Accounting Foundation, and its sister board, the FASB, to advancing diversity and equity and inclusion, it was really a no-brainer to respond to that request. Now, full disclosure, I wrote Statement 98. As I often got assigned when I was at the GASB to lead projects that weren't originally anticipated in the technical plan. And apparently I was the only one on staff who wasn't busy. And I was really very happy to do this and pleased that we were able to do something that relatively quickly that wasn't in our original technical plan and for which we otherwise wouldn't have had the resources to do. But like I said, I think it was a no-brainer and everyone thought it was the right thing to do.
All right, coming into the home stretch. Poll question number 12. This is our last poll question. After implementing statement number 93, which reference rate is not appropriate to be used? Is it LIBOR, SOFR, the effective federal funds rate, or the SIFMA swap index? I'll go ahead and launch the poll. Which one of these four should you not use after implementing statement number 93? As a reminder, in addition to answering 80% of the poll questions, you need to be logged in for 100 minutes, which is why we go a little long on the 2 50-minute sessions. We want to make sure that people who come in just a little late still have the opportunity to get their CPE credit. So make sure you're on for the full 100 minutes and answer 80% of these questions. And you guys are doing a great job. We've got about 88% of the participants have answered the question. We'll give a couple minutes for 1 or 2 more to come in. If you have any questions for the presenters on any of these subjects or anything you think is GASB related, feel free to type that into the Q&A box and we can certainly address this as we wrap up our session. We've got some really great experts on our presentation today, so go ahead and pick our brains. All right, I'm gonna go ahead and close that. We've got a lot of answers in, and 72% of you got the correct answer, which is LIBOR. After implementing statement number 93, we should not be using LIBOR anymore. All right, bring it back over to our presenters.
Okay. Well, we are ready for any additional questions at this point in time.
We're waiting for one to come in. A highly technical, clarification I'd make with respect to LIBOR is if a government wants to continue to use LIBOR in its derivative instruments or its leases, more power to them. What they can't do is treat a hedging derivative instrument that references LIBOR. They can't consider that a hedging derivative instrument after implementation of Statement 93. So they can do whatever they want in terms of structuring their financial instruments, but when it comes to the accounting aspect of it, LIBOR will no longer be an allowable reference rate for a hedge of taxable debt.
Okay, and I wanted to reference an earlier question about the 180 days. Kind of a slight twist to that is if, say for instance, that was a 12-month non-cancelable lease, and then at the end of the 12 months, they could cancel with 180 days notice. The non-cancelable term would be the 12 months plus the 180 days, which would make it a long-term lease. So just be careful how you're applying that maximum possible lease term criteria.
All right, we did have one question come in, which I think is a really great one, in fact, because or at least a great one for us to think about. I know when I've been looking ahead, these SBITAs or however we're going to call them in the future, the subscription-based information technology agreements are going to be very similar to lease accounting and how they're implemented. And I think they're going to be a lot more comprehensive even than leases when you start thinking about what qualifies as a SBITA. So the question is there any additional clarification on the definition of a SBITA or what is to be included? And I think that's definitely worth a couple minutes of discussing, because it's something you should be thinking about now, getting together as you had to get part of your operating departments and all, outside of finance to figure out where all your leases might have been stashed away. SBITAs, I think, are going to require even a little more digging. So Dean or Yvonne, would you like to address this one?
Well, Dean, let me start this off and then you can pick it up from there. But originally, and if I understand this correctly, from what Dean has told us, is that this was originally referred to as the cloud computing standard. But once it has arrived in its final form, it is so much more than cloud computing. And from there, I'll let Dean kind of go over the evolution.
Sure, and that was what it was called initially, because those were the types of transactions that were prompting stakeholders to ask the GASB for guidance on how to report them, because they didn't appear to be applicable under Statement 51 on intangibles. They were not under the scope of Statement 87. I think what the GASB came to realize in looking at the issue was calling it cloud computing was too limiting, and the key thing here was that these IT arrangements were based on subscriptions, and so it's not like acquiring a perpetual license for software where you're actually purchasing the software, but you're gaining the usability or serviceability of software or applications that are resident in the cloud or on someone else's server rather than on your own computers. And so they're the possible transactions that are, could be covered by this are more extensive. That being said, I think a lot of the additional things that people might think of, are probably going to be relatively small and may not meet your materiality threshold. But it's still, at least in terms of implementation effort, going to require some time, as you did for leases, in reaching out to other parts of your government to find out if they've been entering into these types of contracts, which I think they may be even more likely to be doing in a decentralized fashion than for leases. And I think for leases, we found out that there are quite a few governments that where many parts of the government entered into leases, and it wasn't all centralized under a single leasing function, which added to the level of difficulty in applying the standards. With respect to whether there's been any clarification of the definition of a SBITA, I know that the GASB, in preparing for next year's implementation guidance update, which should be available in the next month or so for public review, they spent some time talking about cloud storage in particular, and in the end weren't able to resolve the issue as part of that implementation guidance. And I think if they're going to take it on, may need to actually issue a statement to provide guidance on whether cloud storage is it involves hardware or if it's just software, and that's the crux of deciding whether that should be accounted for as a SBITA under Statement 96 or as a lease under Statement 87.
And that was the point I was going to make, Dean, is that oftentimes those contracts are going to have a hardware and a software or a licensing component, and may need to be looked at as two different items, or if it's immaterial, may be combined. In terms of the term, are GASB 96 SBITAs, are these applicable only for terms exceeding 12 months? Again, it's the short term maximum possible term applies, and so it only applies to those terms exceeding those 12 months of the maximum possible term, but they don't call it a lease term. Is that correct? Did I say that right?
Yes.
Okay. And then the debt disclosure, for debt disclosure requirements in the statistical section and MD&A, should leases be included since they are excluded from debt disclosures for GASB 88?
Well, of course, the statistical section and MD&A are SI and RSI respectively. They're not disclosure. And so statement 88 doesn't apply to them. Statement 88 excludes leases from debt disclosures because statement 87 basically requires the same disclosures, that are required for other long-term liabilities and for debt. They have, for instance, their own disclosure of minimum lease payments for the next 5 fiscal years and in 5-year increments thereafter. In terms of reporting your reporting an MD&A, if your leases are of significance, it doesn't matter whether you report them as part of your discussion of overall financial position or discuss it as part of the capital asset and debt section. If they're significant and they're part of the explanation of your government's financial health, you probably ought to be mentioning them, and they definitely should be included in the outstanding liabilities in the statistical section, because leaving them out, I think, understates the amount of indebtedness of the government.
Back to GASB 96. What about software that was first purchased on the servers and on their servers and then switched to cloud-based?
Well, that's not the same contract.
Okay.
I would almost guarantee that that's an entirely separate contract. So you purchase, when it's resident on your own server, you've purchased it. That's what a perpetual license is. It's another word for buying the software. If at some point you stop using the software as it's resident on your own computers and you switch to cloud-based software, you've almost certainly entered into a new contract, and chances are that is going to meet the definition of a subita.
Okay. And then can an IT application under subscription but hosted on their own servers be considered a subita?
It's not impossible. Where it's located is not really the issue. It's how you're acquiring the right to use that software, so that's what the definition of a subita is focusing on. It's the acquisition of a vendor's IT software, and it doesn't say anything in the definition as to where that software is installed.
All right. Oh, how would we need to report the prior year restatement for GASB 87?
Well, interestingly enough, 87 and 94 and 96 all require that your initial measurement of the liability and the other financial statement items be based upon the facts and circumstances as of the start of the period. So even if there weren't separate restatement requirements in statement 100 for a change in accounting principle from implementing a new GASB pronouncement, you still, in order to comply with 87, have to measure as of the beginning of the year. And so you're going to have that liability amount as at the start of the year, and you're going to restate under the provisions of statement 62.
All right.
Unless your intention is to early implement statement 100 at the same time as you're implementing 87, in which case you could apply statement 100, but you need to early implement all of statement 100 and not just early implement it with respect to 87.
All right. April, you want to take us home?
Absolutely. Well, thank you, everybody. We had wonderful attendance for this. I hope you got as much value as I did out of learning about these standards, how they're going to implement, how we're implementing them, some good tips and tricks and resources for more information. Thank you, Yvonne and Dean, for guiding us through that. Thank you, everyone, for joining us. Again, we always love to hear from you on our social media. We have CRI CPA is how you find us everywhere. And thank you so much for attending, and we hope you have a wonderful time. And if you're in the path of Ian, stay safe. Thanks, everybody.
Thank you.